6 going on to 7 years now. So I love what you guys are doing, especially providing this knowledge and this information to our youth. So love what you and your company encompasses and what you guys value to our community. So yeah, I'm excited to share today's presentation. Let me see if I can share my screen here. Can we get the host to allow me to share screen?
Try
Okay.
Okay, let's see here. Perfect. Can everybody see my screen?
Yay. Yeah.
Yay.
Awesome. So as you guys know, my name is Ger Yang. I work for a company called Blue Water Credit. We are actually a credit repair company. So our primary focus is to help people that have challenging credit to restore their credit. But second to that, our secondary focus is providing credit education, whether that's to our clients, to our referral partners, to the community, such as you guys, and to Finance by Design. So today's presentation is going to be on how to have a better future by having smart credit. And I want everybody to be able to take some notes if possible. If not, I am open to providing this PowerPoint slide to anybody that's interested. So at the end of the presentation, I'm going to go ahead and drop my contact information. So if you want a copy of these slides, feel free to send me an email. I'm more than happy to give it to you complimentary. And then also towards the end of the presentation, I'm going to go ahead and open it up to the floor for questions. So through the duration of our presentation, jot down some notes, jot down some questions. I'm sure I'll have the answers for you at the end. And if I don't, I'll be sure to find them and get you the answers, okay? So with no further ado, by the end of this presentation, you will know the definition of credit in its full form. You will know how credit will impact your day-to-day life. And you will know how to have a successful future by having smart credit. So what exactly is credit? The word credit comes from the word credible or credibility. And the definition of, of those words is the quality of being trusted and believed in. So when you go to a bank and ask to borrow a loan, the bank wants to know if they can trust you, if they can believe in you to be able to pay them back should they provide you a loan for your needs. Our credit system is like a report card for people over the ages of 18. And I'll go over more of what that may look like in the upcoming slides here. Why is credit so important? I tell my clients every single day, unless you have cash to pay for absolutely everything you need and you want, then you absolutely have to rely on credit. And here are a few examples. So you're going to need credit to be able to rent a home or an apartment. You're going to need credit to purchase a vehicle. The next time you're outside in the car driving around, look at all the brand new vehicles that you see. In the United States, over 80% of brand new vehicles are actually being financed by a bank. You're going to need credit to purchase a home. Same thing, the next time you're out driving about and you see all these homes, over 60% of homeowners are financing their home through a bank. You're going to need credit for emergency funds, such as an economic downswing or unexpected expenses. COVID-19 is the perfect example. Many people lost their jobs or couldn't go to work or were furloughed for an extended period of time. So they needed to rely on credit in their credit cards or personal loans to get them by. And you're also going to need credit for life events, such as marriage, funerals, or maybe even starting a business. Let's talk a little bit about credit scores. Your credit score is going to range anywhere from 300 to 850. So earlier when I mentioned that credit is like a report card for people over the ages of 18, this is exactly what I mean. So in grade school, we're taught that if you have a 90% to a 100%, you have an A. 80% to 89%, you have a B, and so on and so forth. So very similar to that, if you look on the chart here on the left, there's actually not really any differences. Starting from the top left corner, if you're in a 300 to 579 range, that would be considered poor credit or an F in this case. And then fair credit or a D, 580 to a 669. If you have a 670 score to a 739, you have good credit. And then 740 to a 799, you would have a B or very good credit. And then if you're in the 800 club, then that means you have excellent credit or exceptional credit, which is the A range. So how exactly is the credit score calculated? Your credit score is going to be calculated by this single pie chart right here, which consists of 5 different components. The number 1 component is your payment history. Are you making payments on time? Or do you have a perfect payment history? That's going to make up 35% of what makes up your credit score. The second biggest factor that plays into your credit score is your credit utilization. This means what kind of balances you're carrying specifically on credit cards and credit cards only. This plays a 30% factor into your credit score. The third component is the length of your credit history. So in order to be in that 800 range and that excellent credit, you actually have to have a total of 10 years minimum of credit history. The fourth component is the type of credit used, or what I like to call it, the mix of credit that you have. So if you go to a bank and try to purchase and try to get a mortgage for a $400,000 loan, and you only have one small credit card on your credit for say $1,000 on a credit card, it's very likely that the bank is going to decline you because you don't have a mixture of credit. The banks want to see an auto loan, a personal loan, credit cards, different credit cards, things of that nature. And then the fifth component is new credit. So the way you build credit is by activity, things that you are doing now. So that would entail new credit or new accounts that you're opening. Better credit is going to lead you to more money saved. Here's a perfect example. When you purchase your home one day, there's a 90% chance that you're going to fall into a 30-year fixed loan. That's how most mortgages work. And the higher the credit score you have, the better interest rate you're going to have on the loan. So of course, the lower the interest rate, the more money you're going to be able to save. So in this chart here, let's compare the very top portion to the very bottom portion. If you have a 760 score to an 850, you're going to get the absolute best interest rate. And on the far right-hand side to that, the total interest that you would pay is $114,000. Versus, let's say you have challenging credit, a 620 to 639, and you have the highest interest rate, you're going to pay a total of north of $200,000 of interest paid. That's an $86,000 difference. And that's $86,000 money that you can be saving by having good credit. So who makes the credit scores? So there's 2 companies that produces your credit score. Number 1 is FICO, Fair Isaac Corporation, which was established in 1956. This is the original company that started to create an actual credit score. And FICO is actually the number 1 company that's being used throughout all banks, still currently to this day. There's another company called Vantage Score, which was established in 2006. So Vantage Score was actually created to try to compete with FICO. They wanted to overrun FICO. but they failed in doing so. So at this point, Vantage Score, they provide what's called educational credit scores for consumers out there. So if you guys ever heard of, Credit Karma, Credit Sesame, or even those credit scores that you see on your bank apps, those are going to be Vantage scores, which are in most cases are free. Now be cautious, because in this picture you see here, you see the same exact vehicle. The difference is the age of the vehicle. On the left-hand side, you obviously see a vehicle that's very much older compared to the modern day vehicle. So I'll compare it this way. Let's compare a Toyota Corolla. They make a brand new Toyota Corolla every single year. Nothing changes about the year and the make. They just make a new version every single year. So just like credit scores, since being established in 1956, there's been many, many different versions, credit scores, that have come out throughout the years. There's actually, to this day, there's actually over 50 different FICO scoring models out there through the duration since it's been established. So it's very important to stay top of mind on your credit scores and what credit score versions are being used. I want to go ahead and talk about closed-end loans versus open-ended loans. So closed-ended loans mean that they have a predetermined end date of the loan. So that means it's going to close eventually. So when you pay off the loan, it's going to close and it's no longer going to exist. An example of that would be on the bottom middle of the column here would be like a mortgage or an auto loan or a student loan. Those all have an end date. You're eventually going to be able to pay those things off. Versus an open-ended loan, this pertains to credit cards only. So credit cards, they will remain open for as long as you choose to. Unless you individually request the bank to close it, it's going to remain open and you're going to be able to use it and pay it off. Use it and pay it off. We like to call that a revolving line of credit. It revolves. So like I said, you use it, paid off, use it, paid off. It's just revolving. And we'll discuss more how that looks like here by showing you guys some examples of how your credit is going to look like on an actual credit report. So these are real life credit reports that I see on a day-to-day basis, and similar to what yours is going to look like in the future. So this first example here is an auto loan. As you can see here, the account type says auto, so that would indicate that this is it's also called an installment loan or an auto loan. And then this is a closed-ended loan because it's eventually going to be paid off and closed. And when I said credit cards are revolving line of credits, this is the perfect example. REV means revolving. So this is what a credit card would look like on your credit report. MTG is mortgage. So this is how a mortgage would report like on your credit report. An INST is installment loan. So that would be like a personal loan if you needed to consolidate debt, or maybe a personal loan if you're trying to go on a vacation and you need a few $1,000s. Or if you're trying to buy a recreational vehicle like a ATV or a motorcycle or a boat, anything of that nature, it's going to fall under the category of an installment loan. And this is an account that is in the negative, that has negative payment history. This is what you want to absolutely avoid having on your credit report. So you notice the differences here. There's a lot of red marks on the right-hand side. You see a 1, another 1, and then 3. And then right above it, I highlighted 30, 60, and 90 plus. So what that means is, in order for you to get a derogatory remark on your credit, meaning you have late payments, you actually have to be a full 30 days late on an account in order for it to hit your credit. So this person has a Capital One credit card of $6,000 credit limit, and they've been late over 30 days once, they've been late over 60 days once, and then they've been 90 days late 3 times. And remember, the number one component that plays into your credit score is your payment history. That plays 35% of your credit history. So by having these delinquencies, these late payments, that's going to be crushing this person's credit score. And here's an example of a collection account. So if going back to the Capital One account here, eventually, if it stays late for too long, it's going to fall into a status called, it's going to be sold to a collection agency. So Capital One, because this person hasn't been paying the balance, they're going to sell it to a third party, otherwise known as a collection agency. In this case would be like a Midland Credit Management. And then they will report on your credit. And the original creditor, in this case, they say Citibank, but if it were Capital One, it would say Capital One. And you want to avoid this at all costs because it's going to do double the damage on your credit. So let's say Capital One sent it to collections to Midland. Capital One is still going to report negative to your credit. The only difference is it's going to have a 0 balance because they sold it to the third-party collection agency. And then the third-party collection agency is going to report another negative account. So that's a total of 2 negative accounts now on your credit, which is doing double the damage. You'll know that an account is in collection status if it says original creditor. Anytime you see that on a credit report, that means that is a collection account. So now that we covered a few examples of what a credit report looks like, let's talk about how to establish credit. So number one, if you are a student, open a student credit card at your local bank. You want to do this right away. Number two, if you are not a student, you want to go ahead and open up what's called a secured credit card at your local bank. So the difference in between a student credit card and a secured credit card is that a secured credit card means it's secured by a security deposit that you have to put down to the bank. So let's say I go to Wells Fargo and I ask for a secured credit card. Typically, the minimum they require is $300 for you to put down as security. And then whatever money you put down as a secured deposit, that becomes your credit limit. So if I put down $300 for security, then I'm going to be granted a credit card of a $300 credit limit. In a student credit card, they don't require a security deposit. You just get a credit line, you don't have to put any money down. And then you want to get added on as what's called an authorized user. You want to, so if you have a family, friend, or partner, parents, guardians, if you know they have a credit card, or you can maybe even ask them, if they do, you want to get added on as an authorized user. So the concept of this is that you will inherit the payment history that took place on this person's credit card. So that way you get credit for it, and that'll boost your credit score, and that'll establish a credit score for you. So I'll give you an example. I have a little brother who just got out of high school recently, and he needed to establish credit. So me looking out for my little brother, I added him on as an authorized user on my Chase credit card. I've had my Chase credit card open for about 5 years, and it's always been on time. So that means that my little brother is going to inherit the 5-year payment history perfect payment history that I built on that card. And he's going to start off with an outstanding credit score to begin with. So that's going to be very important for you all to ask your parent and guardian or family, friend, brother, or sister, things of that nature. So after you establish a credit account, such as an authorized user or a student credit card, a secured credit card, when will you get a credit score? So if you open up a brand new card, such as a student credit card or secured credit card, it's going to take you approximately 6 months to establish your credit score. And your starting point of your credit score is typically going to start off at a 640, which is considered fair credit, or the grade letter C. So that's kind of the starting point for you to either go up from there or go down from there based off your activity on your new accounts. However, if you are able to get added on as an authorized user account, you actually will get a credit score within 30 to 45 days from the day you were added on the authorized user. So ideally, you actually want to, if you're new and starting off the credit, I highly recommend you guys do both, opening up a student credit card or secured credit card and doing the authorized user. So let's talk about credit tips. Number 1 rule, never be late. And remember, this means a full 30 days late. Sometimes life happens and there might be an emergency or things are just slipping through the cracks where you can't pay your bills. If you're late, that's okay, actually. Just don't be a full 30 days late, because that's where it actually impacts your credit and you lose credit points for that. One single late payment can actually drop your credit score up to 100 points. And that late payment will stay on your credit for a total of 7 years. So that's a very long time. It's going to take a very long time to recover that up to a 100-point decrease that you're going to experience should you be late. So that's number 1 rule, never be late. And that translates to the number 1 component of credit score, which is your payment history, 35% of your credit score. So again, this is the same example earlier. This is how late payments would look like, those red marks on the right-hand side. You have to be increments of 30 days late for it to impact your credit score. Credit tip number 2, keep all credit card balances at 10% of the credit limit or less. So the reason why it wants to be at 10% of the credit limit or less is it's almost the same example as your grade. If you have a 90% to 100%, you have an A. 80 to 89%, you have a B, and so on and so forth, right? So if your credit card balance is at 10% of its credit limit or less, that's considered the A range. And then the higher it gets, the lower your score is gonna decrease. So in this example here, the credit limit on this Capital One credit card is $6,000. We know that because if you look right above the REV, the revolving line of credit that I mentioned, right above it says $6,000. That means that's the credit limit on this particular account. And then if you look to the right of that $6,000, there's the balance. The balance is at $7,201. So if you do the math, the usage on this credit card is at 120% usage, where it's supposed to be at 10% or less. So that's a huge gap in between, right? And that's what's crushing this. Not only are the late payments crushing this person's credit score, but it's also the credit usage on this person's account. So remember, the second component that plays into your credit score is your credit utilization. And this is exactly it here. Credit tip number 3, open 3 to 5 credit cards early. So for those that are new to credit, you want to open up a few right away, because your credit history is going to be very important. The reason why you don't want to open up 3 to 5 in let's say a span of 5 years or so, then what you're doing there is you're not allowing your new accounts to age fully. So by opening your accounts right away, like say for example today, if you open 3 to 5 today, those are all going to age at the same time on the same timeline. So an example, let's say you have one credit card and it's been open for 5 years, and you have 4 other credit cards that you have open for 1 year only. Your total average age of your credit history would actually be 8.3 months. Even though you had one card for 5 years, your credit, the credit bureaus and FICO, they take the total average age of all of your accounts, not just one. So that's why I say it's important to open up 3 to 5 credit cards early. The sooner, the better. Good credit history is minimum of 2 years. So FICO, their rule is that they want to see a minimum of 2 years of payment history in order for you, and this is a total average age, remember, of all accounts, a minimum 2 years. That's considered good credit. And as I said before, if you want to be in the 800 range, your total minimum, the total average score or age, I'm sorry, has to be a minimum of 10 years. So as you can see, it's going to take a very, very long time to develop an excellent credit score. Credit tip number 4. So this would be if you have established your credit account already. So once you've established your credit, you want to call your credit card companies at least once a year and ask them to increase your credit limit without doing a hard inquiry. If the bank requires a hard inquiry, then forget about it. The reason why you want to do this is because the bigger the credit limit you have, the better. So the example that I gave you earlier, when it comes time for you to apply for a home loan, let's say you're looking for a home loan of $400,000. If you have a credit limit on a credit card for $2,000, like I said, it's going to be very, very unlikely for you to get approved, because the difference is in the proportion of $2,000. The FICO has only been seeing you manage a credit card of $2,000. How are they going to feel comfortable lending a $400,000 loan to you? Whereas let's say you have a $20,000 credit limit on a credit card on 5 different credit card accounts, then it shows that you've been able to manage, what is that, a total of $100,000 of credit limit over 5 different accounts. At that point, the bank are going to be more comfortable. They're going to think you're credible. They're going to trust and believe in you to lend you that $400,000 home loan. Next credit tip is you have to keep accounts open and active. You do not get credit for zero activity. Again, that falls into the component number 5 on the pie chart, new credit. So FICO, they want to see how well you're doing. They want to see your characteristics. They want to see activity. If you open an account, let's say a credit card, and you don't use it, then you don't get any credit. You have to use it. But you want to use it at a very, very minimal usage. Remember, at that 10% credit limit or less. And then do not submit too many credit inquiries. So if you're going to, Target, you're going to GameStop, or you're going to Chase, Wells Fargo, or you're going to all these different type of banks and you're applying for credit, that's not going to be a good look. You want to do your research and find out what bank you want to do business with and simplify that to a priority list to maybe your top 2 or top 3 and apply for credit at those places. Otherwise, if you're going around and applying for at many different places, that's a bad look, and that's going to cause your credit score to decrease, and it's going to decline your chances of getting approved when you go apply for other places in the future. So for all of you that are in attendance right now that do not have credit and you guys are beginners at this point, this is what you need to do right away. As I said before, you want to go ahead and ask your parent or guardian, maybe a family member, to go ahead and add you on as an authorized user on their credit card. You only want to do this if the card has never been late in the past and have a low balance. Because remember, anything that took place on that card, you're going to inherit. So if it's been late before in the past, you're going to inherit that late payment. And one key thing I want you guys to know is that your parent or guardian or whoever the person is that's going to add you on as an authorized user, this actually has no negative bearing to their credit. So you're not going to be putting their credit at risk by doing this. Second thing you want to do is open up your own credit card. As I said, if you're a student, go ahead and open up a student credit card. That's 100% going to be preferred over a secured credit card. But if you're not a student, then you're going to have to rely on a secured credit card. And then number three, what you want to do is you want to monitor your credit every month. Make it a habit. So just like athletes, for the great athletes, they track their data. They track the time, the laps they're running, how fast they're running in order to be a great athlete. So in order to have great credit, you're going to have to track it every month or every couple months if you can't do it every month. When you have your eyes on it on a consistent basis, you're gonna have that top of mind, and you're gonna make sure that nothing is slipping through the cracks. And that's gonna gain you better credit history in the future. And then number four is do not fall into credit card debt. The example that I showed you earlier with Capital One that had those late payments and that had the 120% usage. That's the prime example of what you don't want to do. So stay away from that scenario as much as possible. And I'm going to give you an example how crucial that is in the upcoming slides here. Stay out of financial prison. This is the example I wanted to show you guys. So this is a Capital One. This is what an actual bank statement looks like, your credit card statement. So this person has a credit card with Capital One Bank. Their balance, as you can see, I circled, is $2,291.79. Their minimum payment every single month that they have to make to this account is only $22. This is how credit card companies try to, quote unquote, put you in financial prison. Because if you look at the bottom here where I highlighted towards the bottom middle, if you pay the minimum payments up until you pay off this balance, guess how long it's going to take you? Well, right below that, it tells you 17 years. It's going to take you 17 years to pay off this small balance of $2,200 or so if you make the bare minimum payment of $22 every single month. This is another prime example of why you want your credit balance to be at 10% of the credit limit or less. I don't know about you guys, but I don't want to be paying $22 for the next 17 years. So highly suggest you guys to stay under that 10% credit limit. Remember, that's the second biggest component. So today we learned what credit is. It's a grade for adults. Why having good credit is important. It's going to give you a successful life. How a credit score is created and by who, which is FICO and Vantage Score. And today you guys got a glimpse of credit reporting. That's your report card for people over the ages of 18. and how to establish credit and credit tips to get ahead. And today you learn how to stay out of financial prison. So I know that was a lot of information, and I know it can be overwhelming. So at this point, I want to open it up to questions to the floor. If any of you have questions, please ask away. No question is no dumb question. So I encourage you all to ask me. And even if you want to do it on your own time, in your private time, or you're shy, here's my contact information. Send me an email with your questions or concerns. If you want a copy of this PowerPoint slide, shoot me an email. I'm more than happy to send it over to you and answer your questions. Otherwise, I'll open it up to the floor. I'm ready to answer your questions.
Yep, go ahead.
Can he be authorized on multiple people's accounts at the same time to increase your credit score?
Great question. You absolutely can. So the more, the better. So in that slide, when I talked about open up 3 to 5 credit cards early, same concept. You can get as many authorized user credit cards as you want. It's just you have to know enough people that have that can do that for you. So yes, the answer is yes, and that's actually very encouraged to do.
Just don't spend.
So Ger, we have one on the chat says, what do you mean by staying under 10% credit limit? Can you elaborate?
Yes. So I want to go back to that slide here. Here we go. All right. So great question. So what I mean by staying under the 10% credit limit, on the credit limit on this card, on this Capital One credit card is $6,000. So if you take 10% of that credit limit, that is $600. So that means the balance you want to carry on this card, you want it at $600 or less. So if you have a credit limit that's $1,000, 10% of that is $100. So you want to make sure your balance doesn't exceed $100 on that card. So whenever you think of that rule, just multiply 10% by whatever the credit limit is on your card. And whatever that amounts to, you don't want your balance to exceed that amount.
So what if you?
So I see another question here in the chat. While being authorized user, do you need to use the card? Great question. So when you get added on as an authorized user, let's say you get it from your brother. Your brother, it's most likely that he's going to be shipped another credit card that has your name on it. Whoever he added on as an authorized user, he's more than likely going to get a credit card with that person's name on it. But the brother doesn't have to give it to that person. And I would recommend the brother not to give it to that person, because it's this person's account, and the sole reason why you're doing this is to just inherit the payment history. So after he adds you on as an authorized user, there's actually no further action needed from you. The brother, as long as he's able to put activity on the card, like I said, you're going to inherit all of the activity that takes place on that card. So yes, in a sense, the card does have to be used by the brother in order for you to build credit, because if the brother is not using the card, then he's not building credit, right? So neither him nor you would be building credit.
How does credit inquiries impact your credits? Like should I go to 10 different dealerships to get quotes and running my credit?
Yeah, great question. So when it comes to auto loans, when you go shopping for a car, or if you go shopping for a mortgage, you actually have a 30-day period to do as many inquiries as you like. FICO understands that you're not always going to find what you want at the first place you visit, whether that's a mortgage or an auto loan. So they actually give you a 30-day time window to go shop around and submit inquiries. And then they will, whatever inquiries that you made, they're all going to condense that into one inquiry as long as you make a purchase. So you do have that leeway. However, if it's just regular inquiries like credit cards and personal loans, things of that nature, those do not have that 30-day time window. So each inquiry will hurt your credit score for a maximum of 5 points per inquiry. So this can be anywhere between 1 to 5 points per inquiry. The good thing is that that only lasts for 1 year. So it only impacts your credit score specifically up to 5 points for 1 year of reporting on your credit. However, credit inquiries stay on your credit for a total of 2 years. It stays on your credit report.
You know how we go shopping, they always ask like, oh, do you want to open our credit cards like TJ Maxx, so we offer 10%, $200, whatever on a point. Do you recommend that?
Absolutely not. Absolutely not. So that's a very great question because I mean, in today's world, almost every store you go to, they have like a store credit card at that store, right? And that's actually how people get into credit card debt, because the way they present it to you or the way they bring it upon your attention can be misleading. And, you know, if you go to 5 different of those stores, that's 5 different inquiries, right? And most of those cards, so every bank is different. Some banks offer better features than other banks. So whether that's rewards points or fees, the type of fees they charge you. So most of those retail cards that you can get at a store, those have very, very high interest rate and really bad fees. So you want to stay away from those as much as possible. If you want to open up a new credit card and establish credit, I highly, highly recommend that you go to a well-known major bank. Or if you do your research, you can go to your local credit union. Usually credit unions, they have very good interest rates, but I would stick with the major banks because they've been in business for such a long time. They have better features, better fees. So I would go that route versus the retail stores you're shopping at.
Thank you.
Great question.
There's one on the chat.
When we asked credit card, when we asked where to go to inquiry. Yeah, so like I said, when you ask for a credit limit increase, you only want to do that if they don't do a hard inquiry. Some banks, they allow that to happen without doing a hard inquiry on your credit. So banks, they obviously know how you've been managing the card, right? So I'll give you an example. I have a credit card with Citibank. I asked Citibank if they can increase my credit limit, and because they know my characteristics, they went ahead and increased it. However, when I went to Wells Fargo and I asked Wells Fargo if they can increase my credit limit, they said, we require you to do a hard inquiry to see if we can increase your credit limit. Sometimes it's just a policy thing, and that's what they require. So if that's the case, like I said, you want to go ahead and just forget about it and deny that request.
Going to the 30-day, like you have to pay off a particular debt. If you're approaching that 30 days and you don't want your credit to be affected, what are some of the things you can do to potentially avoid that credit dip if you get sent off to, you know, collections? Would it better if you take out like a loan, or like be able to wait to be able to make sure your credit doesn't take that much of a hit?
Yeah, so you want to do everything possible to avoid that 30-day late payment, but you also want to narrow it down to the best choice. So whether that's, you know, borrowing money from a family member or making just a bare minimum payment. If you make the bare minimum payment, that's gonna that's not gonna allow you to be that full 30 days late, or that requires you to pull out a loan. Whatever you have to do to avoid that 30-day late payment, you want to do, because like I said, if you get a 30-day late payment, it's gonna haunt you for 7 years. And that's gonna be a very long time. It's better off asking a family member if they can help you as a one-time thing to get you out of to stay away from that 7-year prison. And in terms of the collection, so an account has to be late a certain amount of time in order to get into a collection status. So the way it works here, if you look on the screen, the account has to fall into what's called a charge-off status to go to collection. And a charge-off happens when an account has been late more than 150 days. So it has to be 30 days late, 60, 90, 120, and then 150. And then once it's been 150 days late, it will go into a charge-off status. And then from there, it's up to the bank's discretion if they want to sell the balance to a third-party collection agency, or the bank can just keep it there and not sell it. So it really depends.
Great questions, you guys.
Very great questions.
Sorry, going back to the collections things again. My personal experience, I actually had a medical facility call me that they could send me off to collections because they couldn't reach me sending an actual bill to me. Can other agencies send you off to collections besides just banks?
Yeah, very great question. So it's hard to tell what companies do. You kind of have to look at the fine print, but any companies that report to the credit bureaus that does credit reporting, they will send you to collections. So aside from banks, the companies that I can think of right off the bat is medical institutions like you just mentioned, or utility companies, whether that's your local PG&E or if it's your cell phone company like AT&T, they send people to collections. Verizon, T-Mobile, insurance companies, they send you to collections as well, like Progressive, Allstate, Geico. So those type of companies will send you to collections.
Is it true that medical collections don't affect your credit score now?
That's false. So if there's a medical collection that's reporting on your credit, it will absolutely hurt your credit score. However, when it comes to banks trying to qualify you for their products that you're applying for, most banks, they don't really consider the medical collection in terms of the balance. They don't necessarily care that you have a medical balance owed, but it does. The medical collection is affecting your credit score specifically. So although the balance doesn't really matter to that bank, it's still hurting your credit score, which is the primary thing that banks look at to qualify you for their product, right? Your credit score. So medical collections absolutely matter. So that is important. Great question.
Anybody else?
Any other questions? Don't be shy.
Yeah.
Okay, what if you use more than 10% of your utilization but paid off right away? Is that the same impact? So with
Yep.
30 days, you pay off your balance, let's say
Like
like
right
6,000, yeah.
Mhm. Yeah, if you paid off right away, like we're talking about the same day, then your credit utilization is going to be fine. It's if you hold the balance all the way, it's generally 5 to 10 days before your due date. Whatever balance you have that's on your card, 5 to 10 days before your due date is what will be reported to your credit report. I hope that answered your question. If you need clarification, let me know, because credit balances and the utilization, especially the timing, it can get very, very tricky. But the general rule of thumb is whatever the balance is on the card about 5 to 10 days before the due date, that's what's going to get reported to your credit report.
Or we have one on the chat.
Yeah, let's take a look. The schedule of recurring monthly minimum payments, say $50 help avoid. Great question. So I love that you asked that because,
Read the question out loud so that the screen here is a little
Yeah.
hard to see, so if you
Sure.
wouldn't mind.
yep. So the question in the chat says, does scheduling a recurring monthly minimal payment, say $50, help avoid crossing the 30-day late payment, 60-day late payment, 90-day? So this is actually the perfect example that I give to all of my clients on a daily basis. So the most efficient way to use your credit card is to, if you have a small utility bill like Netflix, Hulu, Apple Music, whether it's as your electric bill, I would say use your credit card and set that on auto pay to pay off that small bill every single month. And then from your regular checking account at your bank, set up auto pay from there to pay off the credit card every single month. So that way the credit card is always being used at a very minimal rate, is always getting paid. It's out of sight, out of mind, and you don't have to worry about it. And you're building credit all at the same time. So that's the perfect example and perfect scenario on how to use a credit card. Now, of course, you can use it as you like, but that would probably be the most efficient way, especially if you have multiple credit cards. One of the big challenges that I run into that clients are having is they have so many credit cards. So it's hard to manage. You know, if someone has 8 credit cards, that may be challenging to hover and cover 8 different cards every single month. Whereas if you have, 8 different small little bills, you can just utilize that technique that I just told you. And yeah, that will absolutely help avoid you from getting any 30, 60-day, 90-day late payments.
Okay. All right. So everybody that's on the
There's one
Zoom,
more.
oh, there's one
in
more,
the chat.
okay.
Yep, I see one more that just popped up in the chat. It says, is it recommended to pay the credit card 5 to 10 days before the due date? So the answer to that would actually be yes. However, I would keep a very small balance on the card. So don't pay it off completely, but maybe pay it off where there's $1 or $2 remaining on the card. The reason why I say that is because although paying off your entire debt is great, there's no blame in that. But FICO, they actually want to see a small amount of debt on your credit. As crazy as that sounds, they actually want to see a small amount of debt on there because they want to see how well you're managing it. Otherwise, if you're paying it off every single month and it's reporting zero balance every month, then that in the eyes of FICO, it makes it seem like you're not doing anything on that card. So that's why I say there's that rule of you want to stay under 10% of the credit limit. You want to keep a very, very small balance.
So Jer, are you saying to keep a small balance revolving or to still pay it off on the due date?
I would say, so if you're paying it off right away.
Not right
Okay.
away, but if you set up all your auto payments, like you charge subscriptions of $50 and you set a $50 minimum payment, but then you have another $40 or $50 on the card
Mhm.
and the due date comes up.
Mhm.
Are you saying to pay it off by the due date or to leave $1 or $2 on it and miss the due date and miss the payment date?
No. So if you're doing that, if you're paying off the entire balance at the due date specifically, then such as that example that I told you on how to use the efficient way to use a credit card, then that's fine.
Yeah.
Because the credit card company, they're going to pick up on that balance of what's reporting that you just paid off at the due date. What I meant by you paying keeping a small balance, that's only if you plan on paying off the card right away every single time you use it.
Gotcha. Just want to clarify that. Like, don't leave a balance and don't incur fees.
Absolutely.
We're gonna build credit.
100%. Yep.
Okay.
Thank you for clarifying. I think I saw another one.
Last question.
Small balance should be the same every month, or should it be different every month? As long as it's under that 10% rule. So as long as it falls under that range, then you're fine.
One last one. Okay, Katie, fine.
How does he manage your credit every month? You said to look at your credit every month. What does he do to do that?
Did you hear that?
To monitor the credit every month?
Are you asking me how I personally manage my own credit every month?
Yeah, like what would you recommend of how
What does that look
to
like?
monitor your credit every month?
Yeah. So for me, number one thing is making it a habit. Like I said, monitoring your credit every single month. I log into my bank account probably twice a day. I know even if I didn't make a purchase that day, I'm constantly monitoring it, especially in today's age where there's a lot of fraud happening. You know, if you're surfing the web, people can get your credit card information. It's always a good habit to monitor your accounts in case fraud happens, because sometimes what happens is there will be a unauthorized charge and you don't know about it, and then that'll cause your credit to, you'll get a late payment on your credit, and you'll wonder why that happened. Well, if you monitored your credit, you'll see those that activity. So the number one thing is just monitoring and having eyes on it pretty much almost every day. That's my number one way of having great credit. So I would highly recommend that. And then also downloading a free app like Credit Karma. Although those scores are not accurate to what you would see at a bank, what it allows you to do is it's a kind of a centralized platform where you can see all of your credit accounts. It's kind of like your report card on your phone screen. So you have eyes on it. So that's a good tool to monitor. It's not a good tool to rely on the credit score specifically, because that's not the score that banks use, but it's a nice way to monitor your accounts.
And since you went there, that's how I monitor my accounts. And it does send me an email whenever there's an inquiry. Or whenever, maybe not necessarily a fraudulent charge, but if anybody does any kind of soft or hard pull, it sends an email letting me know it happened, and I can verify it or call in at that point. So that kind of helps with that too. Yep,
absolutely. Most credit monitoring platforms such as Credit Karma, they have alerts. So they'll send you those alerts that you just talked about. So yeah, it's great.
So we're going to conclude our first half, and those people who are online, we do have a survey. If you could fill it out for us, it's very important for us to get some feedback. What we did well, what we didn't do well, how Ger did, give him a shout out. So we just really want to thank you for your time, Ger, and all the wonderful information to all our participants.
Absolutely. Like I said, this is a passion of mine, providing credit education to our community. So I appreciate you guys' time and for having me on. My contact information is here one last time. If you have any questions, shoot me an email. Otherwise, I hope that we can possibly do this again in the future. And thank you all so much.
Thank you.
Thank you.
Bye, everyone.
Bye.